Okay, now we're getting into the tax treatment of whole life insurance. And the important thing to understand is that if set up and managed properly, everything about this should be tax free. Your cash value growth is tax free, the death benefit is paid out tax free. But this goes through some of the nuances of the tax treatment. So, what is this 7-pay premium here? This is a lot of inside baseball and technical details that you probably don't need to know unless you're a life insurance agent. But basically, the IRS requires that we have a certain structure in the policy in order for it to meet the IRS definitions of life insurance and therefore stay tax free. If we go outside of those guidelines, then the life insurance policy becomes what's called a MEC, a modified endowment contract, and then the cash value becomes taxable. Death benefit is still tax free. It could be subject to estate tax if you have a very high net worth, and there are ways to navigate that using whole life insurance. But the cash value, if you were to access it above your basis, could be taxable if you're using a modified endowment contract. Now, there are use cases where a MEC, a modified endowment contract, makes sense because there are advantages to a MEC. There's some additional design flexibility that we have. So you'll notice with Boley and Coley, bank-owned life insurance and corporate-owned life insurance, they're typically using MECs, modified endowment contracts. For some older clients in certain situations, it can make sense. But most of the time, we're trying to avoid MEC status. And a lot of the art and the science that goes into case design means maximizing your cash value growth while still meeting the 7-pay test and therefore keeping the policy tax-free. There are actually two different tests that are applied to determine MEC status. One is called the 7-pay test. One is called the guideline premium test. And any life insurance agent who tells you that he fully understands the MEC rules is lying. You would have to be an actuary to really understand the rules around the MEC status. Why is this important? Again, we want to design the policy in a way that your policy is going to be tax-free. And this premium payment here, what this is saying is that in order for this policy to meet IRS guidelines, we cannot pay more than $68,000 a year into the policy. That's what's called the 7-pay premium. So some life insurance agent will tell you, therefore, if we want to maximize cash value efficiency, we want to pay right up to the MEC limit, but no more. So maybe we want to pay $67,000 into this policy. That thinking is very flawed. That life insurance agent is showing that he doesn't really understand how this works. Notice it says 7-pay premium, not 1-pay, not 1 year, 7. It's a 7-year rolling window that is applied. And the MEC test always applies and is basically recalculated every single year. So you could put a policy in force that's not a MEC when you first put it into force, but becomes a MEC later because you paid too much in premium because the policy wasn't designed properly. And once the policy becomes a MEC, it's always a MEC, and the tax status applies retroactively. So you could have a policy in force for 40 years and be using the cash value and doing infinite banking and doing all these wonderful things. And then the policy becomes a MEC because the premium was too high. And now that tax status applies retroactively for the past 40 years, and you owe all that tax burden over a 40-year period in 1 year. That's a pretty big financial burden. So some agents will design policies very aggressively, and I don't think they realize they're doing it because they think that just because the illustration says that the policy is not a MEC means it will never become a MEC. That's not true. That is not true. And those agents unwittingly are building into their policies the risk that the policy might become a MEC at some point in the future. So I design policies more conservatively because, in my opinion, it's never worth taking on the risk that the policy might become a MEC, a modified endowment contract. And there are ways of navigating that. I'm trying to stay out of the weeds here, but it's difficult because this is an important topic. Because you will see agents who they think they're doing proper case design, but because their understanding is somewhat superficial, what they're really doing is manipulating the company's illustration software to spit out the best possible numbers. And they think the numbers are gospel and that the company's illustration software is an oracle. It's not. And there are so many other things that go into the policy, like the flexibility of the paid up additions rider, that are not going to appear in the numbers. And what the numbers will not tell you is there a risk that the policy might mech. It would be like if I were a structural engineer and I found a beautiful way to design a building for you a lot more cheaply with a lot less foundation so you could get it up quickly. But what the diagram isn't show you is now, if there's a strong wind, the whole policy collapses. The whole structure collapses. And that's what some agents are doing. So understand what this 7-pay test means. This does not mean that you can safely pay up to $67,000 into the policy and it will never become a mech. It does not mean that. It's a lot more nuanced than that, and I cannot explain it to you in this video. But that is a rolling 7-year test, and it reapplies every single year. So if you were to really pay up to $67,000 every year, this policy would almost certainly become a mech, probably over the course of 5 years or so. So a lot of these policies that are designed more aggressively, where the early cash value looks a lot better, that's where the allure, the attraction of those policies is. Those policies are building in a risk that the policy could become a mech. And I design policies more conservatively. So if someone wants a policy design like that, I'm fine as long as they understand the risk that they're taking on, that we're building in the risk that the policy could become a mech. So I design policies more conservatively, where there's a higher base premium, there's a bit lower early cash value, but now we have a safer, stronger, larger foundation so we can build for the long term, and we're avoiding the risk that the policy would mech. I'm okay designing the policies more aggressively as long as the clients understand all the trade-offs that go into that and the potential risk of the policy becoming a mech. So that's really important. There's a lot of inside baseball we could get into here, but I think some agents, because their understanding is superficial, pass on that superficial understanding to their clients, and their clients think that because the numbers on the page and the supplemental ledger of the illustration look better, therefore the policy is going to perform better. It might perform better, but if it then becomes taxable, that extra performance is now more than negated by the fact that everything now becomes taxable, as an example. Or there might not be the flexibility in the paid up additions rider, where if you don't pay the full annual premium 1 year, all of a sudden everything changes. So I don't want to over-engineer a solution and try and give you the perfect policy where everything's engineered to the minutiae. I want to give you a policy with some fault tolerance where everything will continue to work, even if you have some strong winds hitting your financial life, which they almost certainly will at some point over the next 10 years. And some strong winds hit the policy, it will not become a mech. It will still be stable. And that does mean that maybe the numbers on the page don't look as good, especially in the early years. But that's because I'm designing it more structurally sound. So this is important to understand, and we could do a whole series on this. Probably you don't need to understand it if you're not a life insurance agent. But what you do need to understand is that we are trying to design a policy such that it will never be taxable. Not only is it not taxable, not a mech today, but it will never become a mech in the future, no matter what happens to dividend rates, no matter what you do with your policy. So here again, a policy that does not meet the qualifications of this test is referred to as a modified endowment contract, mech. And a mech, you could have tax consequences. If you never touch the cash value, then it's a non-issue. You're never going to be taxed. The death benefit is still going to be tax-free. There could be estate taxes if you're a super high net worth person, but there'd be no income taxes. And even with a mech, you can still withdraw cash value to your basis without incurring taxes. But if you withdrew cash value above your basis, then that would be taxable. Or same thing with a policy loan. And if you touch the cash value prior to age 59 and a half in a mech, there's that 10% penalty. It's treated like a retirement account. There are those same limitations. So again, the 7-pay premium test may be adjusted under certain circumstances over the lifetime of the policy. So again, it's not as simple as it may seem on the surface. You would really have to be a life insurance actuary and maybe also a tax attorney to really understand how all the mechanisms work. It's not as simple as if you just pay less than this in premium, it will stay tax-free. No, it's not as simple as that. Okay, then it talks about taxation of distribution. So the accumulated value of life insurance policy, that's the cash value, is tax deferred. Okay, but may be subject to taxation at the time of full surrender or dividend surrender. So if you were to surrender beyond your basis, that would be taxed. That would be considered a taxable gain. If you borrow out via a policy loan beyond your basis, that is not taxable because you have not realized a gain. Just the same as if you sell an appreciated asset, that appreciation is now a taxable gain. But if you borrow against that appreciated asset, there's no tax consequences because you haven't realized a gain. In fact, not only are there no tax consequences, if you incur borrowing costs, those borrowing costs could be tax deductible depending on what you're using the proceeds for. So the cash value grows tax deferred, and as long as you're not surrendering cash beyond your basis while you're alive, you should never pay taxes on it. And then the death benefit will pay out income tax free. Again, there should be no tax consequences there unless you're a super high net worth person, you're married, you're worth $30 million, and you have $30 million of death benefit. Potentially, you could be subject to estate taxes. But even then, there's a way using trust that you can navigate that as well. But the point here is that everything should be tax-free if it's set up and managed properly. That's where you have to be working with a good agent like myself. That's a lot of where the art and the science of case design comes in. Okay, again, as I just said, if your policy is not a modified endowment contract, the tax treatment of any death benefit provided will qualify for income tax-free treatment, so that death benefit will not be subject to income tax. Surrenders could be taxable. So again, if you surrender cash above your basis, it could be taxable. If we're doing infinite banking, we're pretty much never surrendering any cash. But even if we were to do a partial surrender, as long as we're not surrendering above our basis, it's still going to be tax-free. Okay. Loan balance could be taxable. So again, if you surrender above your basis, it's considered a taxable event regardless of any policy loan outstanding. So if your policy is a MEC, death benefit will still be income tax free. Okay. You could be subject to taxes and penalties. Okay. On distributions, as I said before, a 10% penalty if you take distributions prior to age 59 and a half. So generally speaking, we're trying to avoid MEC status, which should be easy to do with a life insurance agent who knows what he's doing. But there are some use cases where MEC does make sense. So MEC is not necessarily bad. There could be some use cases where that trade-off is acceptable, where maybe we're not planning to touch the cash value, so we're not worried about tax status. Or maybe we're only going to touch a certain amount. Or the extra liquidity and flexibility and case design we get is worth the trade-off. So in the vast majority of cases, we're trying to avoid MEC status, but there are some use cases where MEC status would be acceptable, but you would know that going into it. Okay, and then this is just in the illustration, we're assuming a 28% tax bracket. It doesn't really apply too much here because we're not showing taxes being paid. This is more information about Penn Mutual. And then we go into a bunch of definitions. I'm going to skip through these pretty quickly. Yeah, these definitions, you can read through them. I think most of them are pretty much self-explanatory. You can pause the video and read through some of these definitions if you want, but I don't think these are particularly illuminating. Most of them are self-explanatory. I do want to point out here net cash value. It's important to understand that the gross cash value in our policy is always growing. It's never interrupted. So we're showing you the net cash value. So when you take out a policy loan and borrow against your policy, the net cash value goes down. The net death benefit goes down. But the gross death benefit and gross cash value continue to grow. Just the same as when you borrow against your house, your net equity in your house is reduced, but the value of your house keeps going up. The rental income you're receiving from that house keeps going up. It's the same thing here. So the seen versus the unseen. It's important to keep in mind the unseen. We are never interrupting the growth in the cash value. That's really important to understand. So the cash value numbers we're seeing here are the net cash value, not the gross cash value. Gross cash value and gross death benefit keep going up even while we're borrowing. That's really important to understand. So that compound interest curve is never interrupted. So keep in mind what is unseen as well as what is seen. Okay, this is a summary of the values that we've already looked at in the supplemental ledger. These values are actually a little bit different because in the supplemental ledger, we are actually taking a reduced paid up. These come from the basic ledger where it's not assuming we take a reduced paid up, or it's assuming we keep paying those premiums. We'll go into that a little bit more when we get to the basic ledger. Of course, if you were actually doing an application, this will be signed. So again, this becomes a contract. That's what's so important about the illustration. Right now, it's just an illustration. If we go through a formal application process, and this is in fact the policy that you're signing up for, it is a contract, and it is a completely unilateral contract. You are not signing up for anything when you sign your name to this policy. All you're saying is, I understand the terms of this policy, and I didn't lie on my application. The insurance company is the one providing all the guarantees and taking on all the liability. So this is the opposite of the relationship we have with our typical Wall Street assets, where we are shouldering all the risk. And if we sign anything, it's to release liability from Wall Street, to say, yep, I understand there's all this risk and nothing is guaranteed and I can't sue you no matter what happens. It's all on me. I understand all of this. Here, it's the opposite. The insurance company is shouldering all the risk, not you. They're the ones providing you the guarantees, and you are signing up for nothing. You're not even promising to pay a premium. Now, obviously, you should want to pay a premium, because if you don't, your policy will lapse at some point. But we should want to pay a premium, and we should want to pay the highest possible premium for the longest possible time frame, once we understand what we're signing up for. However, we don't have to. And there are non-forfeiture options to keep the policy in force should we decide we don't want to pay a premium anymore. That's important to understand. So some of these people who go and talk to other financial professionals who don't like whole life insurance, I wish those financial professionals would at least explain to the client their non-forfeiture options. Because if you hate that whole life insurance policy and you don't want it anymore, there are so many options you have that are better than just surrendering the policy. You can utilize these non-forfeiture options such that you can keep the policy in force, keep that death benefit and cash value alive without paying any more premiums. Or you can sell the policy to me. If it's a good, well-structured policy, I'll buy it from you. There is a secondary market for permanent life insurance policies. It's called life settlements. Big-time investors buy them all the time. I do too. So if you're considering surrendering a whole life insurance policy, come talk to me. I can explain to you your non-forfeiture options. And if it's a good, well-structured policy, I will offer to buy it from you rather than see you surrender it. Now, this is the basic ledger. So we already went through the supplemental ledger. The supplemental ledger allows us to illustrate various scenarios. So we illustrated taking a reduced paid up at retirement age and then using policy loans as a strategic form of tax-free retirement income. The basic ledger is just basic. We're not assuming any policy loans or reduced paid up or anything like that. It's just vanilla. You pay the premium, that's it. So the basic ledger is not showing any process of infinite banking or anything like that. So this is just the underlying structure of the product, which is still pretty impressive when you see how it works. So the intent of the ledger is not to show you how you might utilize the policy, but just the basic structure of the policy. And what you do with it is really where all the creativity comes in. But the basic ledger and the vanilla policy by itself is already really impressive, in my opinion. Okay, so this shows us the premium breakdown. It shows us the guaranteed and non-guaranteed values. So let's take those in order. First, the premium breakdown. So our total premium is $25,000. We've gone through this a little bit before. That premium breaks down into three components. There's the base premium. This is the foundation. This is the part that is absolutely required in every whole life insurance policy. And this is what drives the performance over the long run. Then there is the term rider. This is adding some temporary term life insurance that gives us additional death benefit in order to navigate those MEC rules, those IRS rules. It's scaffolding that allows us to build higher and faster and stronger. Why? Because term is a very inexpensive way to add death benefit. And the more death benefit we have, the more MEC space we have to pay in premium and get better cash value accumulation. So this is a help to optimize the cash value accumulation. Over time, that term life insurance gets bought out and becomes permanent life insurance, becomes paid up additions. In other contracts, they will have a standalone term rider where after 10, 20, or 30 years, that extra death benefit just falls off the policy. This is what we call a blended term or a blended PUA rider, where the death benefit doesn't fall off the policy, but slowly over time, that term death benefit gets converted to permanent. And then we have the paid up additions rider. This is purchasing paid up additional insurance. It's buying additional death benefit that is paid up. Why is that important? Because it gives you a lot more early cash value. So the majority of the cash value we get in the early years, the vast majority of it, comes not from the base premium, but from the paid up additions rider. Over the long run, the cash value growth comes from the base premium. That's what gives you the leverage in the long run. But in the short run, the paid up additions rider is like a shot in the arm. Okay. Why? Let's remember what cash value is. Cash value is the net present value of that future death benefit discounted for future premium payments. So this base premium is going to be paid all the way to age 100. So when I pay that base premium, we have to discount it significantly. If we're talking about cash value, we have to discount it by all the premiums we're going to pay all the way to age 100. That's a pretty significant discount. However, with paid up additions, there is no discount for future premium payments because no future premium payments are due on that portion of the death benefit. So the paid up additions rider grows a lot more cash value very quickly. Now, if you didn't follow all that technical explanation, that's fine. You don't need to understand it. There's a lot of inside baseball I'm getting into. You probably wouldn't need to understand that unless you're a life insurance agent. But in general, paid up additions drives the early cash value, and then base premium drives the cash value over the long run. And the term rider is a way of optimizing the overall structure of the policy to get us better cash value accumulation over the whole life of the policy. Now we see the guaranteed side of the ledger. So this is the worst case scenario. This is what the insurance company is guaranteeing you. And this is incredible. Look at any other financial asset you have and ask, what's the guaranteed side of the ledger? What am I being guaranteed? When you put your money into 401ks, mutual funds, stocks, bonds, any investment or any financial vehicle whatsoever, ask that person, that provider, that custodian, that financial advisor, what rate of return are you guaranteeing me? What rate of return are you guaranteeing me? Even when you put your money into a savings account, there's no guaranteed rate of return. As we've seen, interest rates can go to zero. Now, hopefully you won't lose any money in your savings account. Hopefully that bank is sound. But there's no guarantee that your savings account is going to grow every year. It could pay you zero. This is the only asset I'm aware of that has a guaranteed rate of return, where it is guaranteed to go up in value every single year. Just keep thinking about that over time and you'll realize how unbelievably powerful that is. You want to have this in your financial life somewhere. It doesn't have to be all of your financial life, but this should be the foundation. So the guaranteed side of the ledger assumes no dividend is ever paid, meaning the insurance company will have the worst mortality experience they've ever had, and they'll have the lowest profits, and their costs in internal expenses will be the highest they've ever been. So the guaranteed rate of return is typically between 2 to 4%. Now, as I say that, It's not as simple as that. When we talk about rate of return in a whole life insurance policy, it's never as simple as a straight up number. It changes over time. Your rate of return gets better over time, and it will be negative in the early years. So when I say 2 to 4%, it's not as simple as that. But the point is, it's a positive rate of return that is competitive with a savings account, and you are guaranteed to get at least that. Penn Mutual has been paying dividends every single year straight since 1848. That's over 170 years of dividend payments. That's unbelievable when you think about that. And it comes back to the unique business model that these companies have. They've been paying dividends all through times of severe economic dislocation because their business model is based on math, actuarial science. They're not speculating. They're based on the science of predicting mortality, which they've done successfully for over 100 years. But even if a dividend were not paid, your cash value would still go up at a rate competitive with a savings account. The non-guaranteed side assumes that dividends are paid and that they are paid at the current rate. So that dividend interest rate will then be paid on top of the guaranteed interest rate. The dividend is driven mostly by the base premium. So the dividend gets very powerful over the life of the contract, but in the early years, most of your cash values go up coming from the guaranteed side because most of it is coming from the paid up additions rider. So you can see in year one, the dividend starts off slow, but then over time, very quickly, it starts to become very significant amounts of money. Okay. So the guaranteed side of the ledger is the worst case scenario. That is what the insurance company is guaranteeing you will happen in the worst case. It assumes no dividend is ever paid. The non-guaranteed side of the ledger assumes a dividend is paid every year at the current dividend rate. Dividends can go up or down. So this is not guaranteed. This dividend payment could be less if Penn Mutual were to reduce its dividend. It could be more if Penn Mutual were to increase its dividend. And then this also assumes you're paying the full premium every year. That's important too, because there's really only two factors, two variables here. The dividend, what's the dividend going to be? And then you, what are you going to do with this policy? And you are the most important variable. If you pay the full annual premium every year, it's going to perform optimally. If you don't, that's okay. There could be reasons why you wouldn't. That's totally fine. Just understand, obviously, it will impact some of the performance. And that's okay. We build in flexibility. We understand life happens. That's totally fine. But that's another assumption that goes into this. So I think that's important when you look at some of these more aggressively designed policies. You might want to stress test it a little bit and show things like, what if I don't pay the full annual premium? What if I pay less? What if I want to pay more? How does that work? And one thing which we are not allowed to illustrate is what if dividends go up? Generally speaking, dividends going up would be a good thing, you would think, right? Not if the policy is designed too aggressively. If the policy is designed too aggressively and the dividend goes up, it could push your policy over that neckline where now it becomes taxable. Also, if your policy is designed more aggressively, it's going to have a smaller base premium, which means it's not going to participate in a dividend increase nearly as much as a policy that has a higher base premium. So again, generally speaking, a higher base premium is a good thing. It makes your policy more stable and it makes it perform better over the long run. A smaller base premium policy gives you more early cash value and more flexibility in the early years, but there's a trade-off where the longer term performance may not be as good, and you could be building in a risk that the policy could mech and become taxable. Now notice in the basic ledger, unlike the supplemental ledger, we're not showing you taking a reduced paid up. So in the supplemental ledger, this is broken across a couple of pages. We are still paying a premium here. The premium goes down, so we are no longer paying the paid up additions rider. That's by design. The paid up additions rider in this policy by design falls off after 30 years. We can design it any number of different ways, so it doesn't have to be this way. But we are still paying what's called the target premium, which is the base premium plus the term rider for a premium of almost $12,000. So we're not taking a reduced paid up. We're continuing to pay premiums in the policy. We're not illustrating any policy loans or income coming out of the policy. It's just vanilla. And you can see we have the ability to continue paying this premium until, oh, what's this little M here? Notice I talked about MEC status. This is what I'm illustrating. This policy, as illustrated, when it went into force, is not a MEC. It's not a modified endowment contract. That doesn't mean the policy will never become a MEC, a modified endowment contract. I deliberately designed this policy such that if we follow the plan and we take a reduced paid up at age 65, everything will be fine. That's the way we've designed it. But if for some reason we didn't take a reduced paid up and we kept paying the full premium, albeit not the paid up additions rider, there's now a risk that the policy could become a MEC. In this example, in year 45 in the policy, when you're at age 80, if you were to keep paying this premium, the policy now becomes a MEC, a modified endowment contract. So I'm just illustrating the principle that just because the policy as illustrated when it goes into force is not a MEC, doesn't mean there's no risk that the policy will not MEC. You have to work with a life insurance agent like myself who really understands the principles behind case design and does not treat the illustration software like it's an oracle, because there are assumptions that go into that illustration. And you might also say, well, I'm 80 years old, who cares? Well, it could be a huge deal. In this example, you will have a $5.2 million death benefit and $4 million of cash value. That's great, but if you've been practicing infinite banking, you've probably been taking out policy loans, and you've probably been using this policy for retirement income, which means of that $4 million in cash value, maybe you borrowed out $3 million and you had no intention of paying those policy loans back because you said, hey, the death benefit will pay it off. That's what I got this policy for. If the policy becomes a MEC, guess what? You now have $3 million of taxable income, and you have that tax bill due in 1 year. In 1 year, because the taxes apply retroactively, because now your policy is a MEC, a modified endowment contract. Now, in this case, let's see, how much did we pay in? I can't see how much we paid in cumulative premiums, but if you had borrowed out $3 million, your tax bill would be $3 million minus whatever your cost basis is. So let's just say you paid in $1 million over the life of the contract. So $3 million minus $1 million is $2 million of taxable income that you would now have at your highest marginal rate, all in 1 year. That's an incredibly significant tax bill. Now, I don't want to panic anyone. To go a little bit deeper into the weeds, if this were to happen, the insurance company doesn't want this to happen. So what they would actually do is they would send you a MEC letter. This is where, again, you need to work with an agent who's actively engaged with you and helping you to manage your policies. A good agent will see that coming, and he will jump on it. And the insurance company will send you a MEC letter saying, hey, Mr. Smith, by the way, if we apply this next premium payment, your policy will become a MEC. Are you sure you want that to happen? And you should respond and say, no, do not apply that premium payment. I don't want my policy to become a MEC. And then your policy will stay in force and it will not be a MEC. All that will happen now is it's going to underperform what was illustrated from then on because you're not able to pay that premium. But that's probably preferable to having the policy become a MEC. So a lot of detailed technical weeds we get into here. I hope this wasn't too boring and dry. Let me know if it is or if it isn't. We will continue this on the next one. Talk soon. Bye-bye.